Hi folks, Chuck Gibson from Financial Perspectives in Pleasanton, California with March 2016's Charts on the Move. Since my last video, intermediate term U.S. stock market action has been very constructive for the bulls, as we've all but erased most of the January decline. But the longer term bear case has not yet dissipated, so I wanted to dedicate most of this month's video showing you why one model I use says this is the case. This is a great teachable moment, so let's get started. As you can see in my first chart, March turned out to be a strong month, as every asset on this table had positive returns. Switching to a year-to-date view, again, a positive quarter, except for only U.S. small caps and EFA, which is the Europe, Far East, and Australia index, as they had a loss of 1.8 and 2.7% respectively. Precious metals were the clear winners on a quarterly view, as both silver and gold had double-digit returns. Taking a look at U.S. sector performance, the quarterly winners were industrials, consumer staples, followed by utilities, which ran up almost 15% on the quarter. Only two sectors lost ground, healthcare and financials. A couple of points of interest to note are, firstly, it's important to remember that utilities are a defensive sector and move inversely to interest rates. And what makes their 15% quarterly rise fascinating is how it was done on the back of a world which is worried about the Fed's threats of increasing interest rates. This divergence will be interesting to see who's right and who's wrong. Secondly, in bull markets, you want to see the leaders lead. Leading sectors typically include technology, financials, healthcare, cyclicals, and the small caps. In weak markets, the defensive sectors lead, which are typically utilities and consumer staples. There's no doubt the wrong sector quarterly outperformance could be attributed to the first month sell-off, and the risk trade is really back on the table. But for me, the Q1 performance is still pointing to the need for a continued cautious stance. Hardly a month goes by and I don't mention the dollar. This month is no different, as it's still the 900-pound gorilla that investors need to watch. As you can see in this chart, we are on our fourth alternating touch in a 15-month sideways consolidation channel. If price breaks down from here below the $94 support line, that will be an indication that it's likely time to jump into the foreign stocks, bonds, commodities, and precious metals bandwagon. If, on the other hand, price bounces off support here, and eventually takes out the upper $100 resistance level, I expect to see price rise up to my $115 target. Those aforementioned investments will likely be in serious trouble once again. If that is the case, those on the short side of the investments will likely be the big winners. Until this consolidation is broken, though, in either direction, I expect to see most markets continue in their own consolidation, and any opportunities should be best treated as short-term. The final part of this video, I wanted to walk you through a very simple but excellent tool to help investors guide themselves through the normal choppy and emotional challenging markets. If you're a regular listener, you continually hear me mention the 200-day moving average, as I use that extensively as a check to ensure my interpretation of the intermediate to long-term direction of a market is correct. Investing rule number one is always to be investing with the trend, and this is a great way to confirm the direction of a trend. So let's start this off with my next chart, which is a 20-year weekly look at the S&P 500 stock index. I've cleaned up the chart and removed all distractions and left only price. You can see how price tends to strongly trend both up and down. Notice during the last 20 years, we have had two fast and powerful downtrends and three strong uptrends, one of which we're currently in the middle of. It should be apparent that downtrends happen at a much faster pace. The old saying of stairs up, escalator down is spot on here. You should also agree that without the benefit of hindsight, it's difficult, if not impossible, to know what will happen next after each little wiggle, hesitation, and consolidation. This is especially true if you're looking to find when the trend has changed, signaling it's a time to get out and protect your gains in an aging bull market. Looking at the chart for a few examples, who would have known that this was just a correction and not the start of a new trend? Or that this was the actual top for this move? Or this area here being the top of the 2008 rally? Or, even today, if where we are today, is this the top for the rally? The fact is, while you're in the middle of a trending move, it's impossible to know what's next, so you need to rely on something other than gut. I have a multitude of methods, and they use the weight of the evidence approach. My next chart is the exact same chart as before, except I've added in the 200-day moving average in red. Some might question how I can add a 200-day moving average when I'm looking at a weekly chart. Well, with 5 trading days in a week, A 40-week moving average is equivalent to the 200-day moving average on a daily chart, so that's actually what's being reflected in the red line. Moving averages act as a smoothing mechanism. They remove a lot of the noise, making the direction determination a much easier task. And to make that point, I'll remove price and just show the plot of the 200-day moving average in my next chart. Notice how almost all the wiggles and noise disappear? The actual value of the moving average is not what's important, but rather its slope. After years of study and backtesting, I have found what works for me is being long an index only if the 200-day moving average has a positive slope. When the slope flattens and reverses, that's my signal to exit and move on to another opportunity. In my next chart, I've gone ahead and circled and added in red a vertical line for each time the moving average reverses direction and begins to point downward. Notice how this only occurred 4 times in the last 20 years, and also how the second signal from the right turned out to be false. The market eventually reversed course though and moved strongly higher. But you should also notice that how the same moving average eventually got you right back in the rally as its slope reversed course and moved higher too. I have circled and drawn in green a vertical line to represent that point in time on my next chart here. If you wanted to use this as a system, a change in slope from positive to negative on the 200-day moving average would be your sell signal, and a buy would be indicated with a change in slope from negative to positive. In my next chart, I've added back in price candles as it gives us a good visual on how well the system has done over the last 20 years. While it does not pick tops or bottoms, it does an excellent job of capturing the majority of strong moves up and avoiding large moves down. To put some real numbers behind those words, a buy and hold approach returned an excellent 216%, while the simple 200-day moving average slope change system I presented returned more than 450%, which is in excess of 2 times that of buy and hold. Like all trending methodologies, its success comes not from taking excessive risk, but rather minimizing losses. Will it always do better? Only if we have trending markets, because this system will likely underperform in range-bound consolidating markets. Something to keep in mind, as there is no one perfect system and why I have many. Before I wrap this up, I wanted everyone to notice that in spite of the strength and breadth of the recent rally, which has been very impressive by the way, the 200-day moving average slope is still pointing downward. And like 3 of my 4 other models, it's recommending caution. With that in mind, it's imperative we are always open to the possibility the market will do just the opposite of what we believe and have an alternative course of action in case it does. As Mike Tyson said, everyone has a plan till they get punched in the mouth. The market has delivered me many punches in the mouth, and I can attest it's never fun. But the goal, though, is to ensure that when it does, it turns out just to be a glancing blow and not a knockout punch. Well, that's it for this month. As always, I appreciate your time and your attention, and hope you found this video informative and helpful. If you have any special requests for the next installment or comments, I'd love to hear from you. You can send me an email at chuck@financialperspectives.biz. Again, thanks for listening. Until next month, this has been Chuck Gibson from Financial Perspective with March's Charts on the Move.